Imagine a company that reports revenue of almost 8 lakh crores. A company that was once one of India's largest companies by revenue. A company where even LIC owns more than 10%. Now imagine that same company destroying more than 80% of investors' wealth. The stock has fallen from 950 to below 100 levels. Now SEBI has come out with an interim order raising serious questions about the company's disclosures, subsidiary revenues and governance practices. Today we are going to understand what exactly happened at Rajesh Exports, why SEBI is investigating what investors may have missed, and most importantly, how can you avoid investing in companies like this in the future. Before we begin, remember that these are interim findings by SEBI and Rajesh Exports has denied wrongdoing. The investigation is still going on. So let's go back a few years. Rajesh Exports looked like a dream company. Huge revenue, gold business, international presence, overseas subsidiaries, one of the largest gold refiners in the world. And when investors looked at the financial statements, they saw revenue numbers that were absolutely massive. In FY26, the company reported revenue of around 7.78 lakh crore. Most retail investors would stop right there. They see a huge revenue number and assume the company is doing extremely well. But revenue alone tells you almost nothing, because the real question is, where is that revenue coming from? And that's where this story begins. This is probably the most shocking part of the entire case. SEBI's investigation found that almost all of the company's revenue was coming from subsidiaries and step-down subsidiaries. Not 60%, not 70%, not 90%. Almost 99% of revenue was coming from subsidiaries. Think about that. If almost all of your revenue is coming from subsidiaries, then investors need complete visibility into those subsidiaries, because that's where the actual business is happening. The parent company itself generated only a tiny fraction of that total revenue. Yet most investors were looking only at the consolidated numbers. This is one of the biggest lessons from this case. Whenever a company reports consolidated revenue, ask which entity is actually generating that revenue. Now let's talk about Valcambi. Valcambi was projected as one of the key operating entities within the group, but SEBI found a major mismatch. According to the regulator, the audited numbers of Valcambi appeared significantly smaller than the enormous consolidated revenue being reported at the group level of Rajesh Exports. This raised an obvious question. If the group is generating such massive revenue, where is the supporting evidence? Where are the underlying transactions? Where are the audited subsidiary numbers? This became one of the central issues in SEBI's investigations. Again, these are allegations and interim observations, but the size of the discrepancy is what made the market pay attention. Now the story gets even stranger. SEBI also looked at transaction involving a company called Affluence shares and stocks. According to the order, Rajesh Exports recorded thousands of crores worth of sales and purchases involving this entity. But Affluence reportedly denied conducting those transactions. Now imagine you're an investor, you're looking at turnover numbers, you're impressed by how large the business appears, but what if some of these transactions don't actually represent meaningful economic activity? Suddenly, the entire perception of the business changes. This is why smart investors don't focus only on revenue. They focus on margins, cash flows, and profits. Now let's talk about the elephant in the room. LIC, Life Insurance Corporation. LIC owned roughly 10.8% of Rajesh Exports. Think about that. One of India's largest institutional investors, thousands of analysts are working there, and huge research teams are there. When the stock kept falling year after year, LIC was still holding stake in this company. So naturally, investors are asking, how did LIC not see this? Could they have identified these issues earlier? I don't have the answer. Maybe they had a different investment thesis. Maybe they were waiting for a turnaround. Maybe they missed something. But here's the lesson. Never buy a stock simply because a big institution owns it. Institutions can be wrong. Mutual funds can be wrong. Foreign institutions can be wrong. You still need to do your own analysis. Now let's discuss something important. Even if you knew nothing about SEBI's allegation, there were several warning signs here. First was, look at operating margins. Revenue was so enormous, but operating margins were practically non-existent. If you're doing thousands of crores in revenue and barely making money, that's a problem. Second, look at return on equity and return on capital employed. Return on equity is below 1%. Return on capital employed is below 2%. For me personally, anything consistently below 10-12% deserves extra scrutiny. Great businesses usually generate 15% plus. Third red flag was here, profit growth was really bad. Revenue numbers looked impressive, but the profit quality was getting weaker year after year. Then another red flag. The stock itself was telling a story to us. The market had already started losing confidence long before the allegations became public. And the stock was making lower highs and lower lows for years. And still people were buying the stock. Sometimes the market spots trouble before we do. This is the part every investor should remember. Revenue is vanity. Profit is sanity. And cash flow is reality. Anyone can show large sales numbers, but eventually you need cash generation, profitability, return on capital, and proper governance. Without these things, even the biggest revenue number can become meaningless. The Rajesh Exports case reminds us that investing is not about finding the company with the biggest revenue. It's about finding companies with trustworthy numbers and strong economics. Whether the SEBI allegations are proven or not, this case has already taught investors a big lesson. Don't get impressed by the size, get impressed by quality. Because in the stock market, trust takes years to build, but only one event can destroy it. And once trust disappears, valuations disappear with it. In the end, I would just say if you found this analysis useful, just subscribe to this channel, like this video, and comment whatever your views are there on Rajesh Exports. And I regularly break down real companies, real balance sheet, and how to invest in the stock market, and tell you about real red flags so that you can become a better investor. So don't forget to subscribe to this channel, and see you in the upcoming videos.